Welcome to Team T presentation. In this video, I will debrief the result of Capsim Round 2. Before going into details, let's take a look at the outline. Firstly, I will briefly talk about selected strategy, then overview the result of Round 2. At the same time, some reviews and evaluations will be offered. Finally is the forward planning of the next round. The strategy we used during 2 years is a combination between need cost leader and need differentiator with product life cycle focus. Need cost leader is mostly applied for low technology segments, such as traditional and low end. These segments have low variable cost and high sales units, from 30% to 40% of total industry, so they are definitely profitable markets that will have high contribution margin and profit compared to other segments. In detail, the cost of R&D, production and material costs will be limited to compete with others. To achieve this strategy for long term, increasing the automation level of these two segments is absolutely essential. Need differentiator with PLC with the characteristics of developing R&D by improving size and performance in every round, high awareness, and easy accessibility helps us gain competitive advantages compared to other competitors. Furthermore, because high-end is more profitable than performance and size segments, so introducing a new product in this segment will help us generate high profit in the future. The next part is the description and evaluation. The result will be analyzed based on this factor. This table is the production analysis. Overall, the result of Round 2 is not good. Our team suffers the opportunity loss on sales because the Apple products were stocked out while we incurred the high inventory cost when there were a lot of unsold units of the remaining product lines. Additionally, due to ADAM, AFT, and AGAP focus on high-end, performance, and size segments, respectively, it means that the company must expend much money on direct materials, labor costs to keep products fresh and interesting to customers. Besides, the marketing team did a wrong sales forecast, leading to high inventory carry cost. Consequently, the contribution margin of the three remaining product lines were very low at 27%, 19%, and 24% respectively. The contribution margin of the Apple and Acra were good at 40% and 34% in order. The next thing we want to introduce is the 2019 income statement. As you can see in the table, the sale of Apple and ADAM that focused on traditional and high-end segment brought the highest amount to the company. The second group was Acra and AFT, but the figure of AGAP was the lowest. As mentioned, the sale of Apple might be even better if our team could predict better demand to prevent inventory carry. Additionally, there were the phones of the company in R&D to meet the customer's demand, sales forecast, and cost controlling. Consequently, only Apple and Acra brought the net margin for the company, while the three remaining came up with negative numbers. Moreover, all the expenditure and long-term interest caused the situation even worse, that net profits was minus $367,000. But luckily, the tax refund helped the company less damaged. As the result, the market share of the company fell dramatically from 16.2% to 12.4%. ADAM took 19.3% of the high-end market share, and together with 2.7% from the AFT, the company owned 22.2% of market share in the high-end segment in 2018. In 2019, we saw that high-end products are our advantages. We had a plan to expand our high-end market share to 30% by modifying the ADAM with new specifications and investing in a new product called Aloha. However, the new ADAM sensors did not meet the customer ideal demand, and the Aloha had not been released yet. In 2019, our high-end segment market share dropped to 7.3%. Our traditional market share dropped from 16.3% in 2018 to 15.4% in 2019. The reason for this is that we failed to estimate the needed sensors to be produced. Our products were stocked out and we lost a number of potential customers, which negatively affected our profit and market share. However, we are still maintaining a competitive role with other rivals. Chester has 15% market share and Digby has 16% of market share. Erie is an exception because the company has two core products in the traditional segment, which contributed its market share to 29.5%. Together with the small number of sales in the performance and size segment, the total market share of our company fell dramatically from 16.2% to 12.4%. Our low-end product, Acre, failed to meet customers' ideal age and prices, which are two most important factors. It resulted to the loss in market share and company's profit. In 2018, we had 13.4% for Acre and it had the lowest market share in the low-end segment. It was not quite a competitive product compared with other rivals. Erie had the highest market share in 2019 with 20.1%. Because of the failure, in 2019, we aim to take back our market share by changing the product specifications in which we believed that it would best suit the customer's demand. However, the situation became worse because the price and ideal age was not set as similar as customers expected. Thus, the new Acre got only 8% of market share, whereas Chester made a change and beat Erie with 21.5% market share. Our sales dropped, and with the cost of R&D and marketing, the Acre sensor failed to bring profit to our company. Now we will discuss the cash flow statement. The cash flow from operating activities was negative of $2.3 million because the loss on income and inventory carry. In contrast, the cash flow from investing activities were positive at around $6 and $10 million as the company sold idle capacity and issued extraordinary stock respectively. As a result, the net change in cash position was around $14.3 million, leading to the closing cash position at around $25.8 million. To compare with round 1, the cash flow from operating activity in 2019 are much lower, even negative, compared with $7.8 million, which means that the company was not productive in terms of sales. Moreover, in 2019, the company had to suffer an expenditure for new products R&D, hence, burdening such spending has taken too much cash on hand of the company. In terms of cash flow from investing activities, Andrew was investing to increase the rate of automation for low-end segment with the amount of around $12.8 million in round 1. However, in round 2, the company was holding so many inventories because of low demand from the customers, which leads them to sell idle capacity with an amount of $6 million. The cash flow from financing activities in 2019 seemed to be impressive more slightly because of the advantage of greater common stock sales compared to that of 2018. Next is the balance sheet. In general, the total asset of the company was around $120.8 million, that the liability accounted for 31.7% and equity accounted for 68.3%. During 2019, the cash on hand and inventory increased double. The current debt and long-term debt fell as company repaid the bonds. However, common stock increased as company issued more stock that raised the market capital by $18 million. However, the retained earnings decreased as loss on sales. The change in total asset was about $10 million from 2018 to 2019. Because the net profit of the year was negative, it caused the negative of return on asset, return on equity, return on sales, earnings per share, and PE results either. Plus, too little leverage indirectly indicates our weakness in strategic thinking and decision making. Furthermore, the stock price of company fell deeply by $6.79 per stock. The investors unhappily realized that the money was used to reduce the company debt and they have been incurred, lost every stock they hold. However, the good thing is the company did not make any emergency loan, which causes a loss of interest if it happens. Our company spent a large amount of money in terms of in terms of HR management compared to our competitors. It takes us $3 million to invest in the HR and we provided 50 hours of training for staff. The amount of money is quite high compared to other competitors, maximum $2.2 million. The reason for this is we had set our targeted segments in the high-end product and we want skilled workers. In addition, we aim to be a company with lowest turnover rate on the market. The result is optimistic since we lowered the turnover rate to 8.1% from 10% in 2018. We completed our goal as we are the firm with lowest turnover rate in the market, 8.9% from the second and 9.1% from the highest turnover rate. However, the extra expenditure also affected our profit in this year of 2019. One of the factors tremendously affected to the overall negative result of is the R&D investment. The company made some inappropriate decisions while setting the criteria for each segment. Hence, the products do not meet the customer demands, which caused the company to lose significant potential of customers, so do sales. After round 2, our team recognized that the low segment was one of the main sources of income, but we failed to design products to meet the customer expectation. We do not need to spend capacity on R&D to keep products fresh, reduce promotion budget to increase customer awareness like all the product lines. We must reduce costs to keep price offered at basic to compete with competitors. Secondly, the company suffered stock out of able both round 1 and 2, thus we must plan new inventory policy for this product. Finally, the main issue caused the loss on high-end performance and side segment is cost of control. Although the market share of the company is higher than most of companies in the same segment, the demand of all segments is low, while variable costs such as direct material and labor and fixed costs such as R&D and promotion are too high to satisfy the customer needs, leading loss income. Thus, the company must resolve costs now. So, the final part is the decisions for future rounds. In the next coming rounds, our team decided we will launch new product called Aloha in high-end segment. Plus, we will keep R&D on Apple, Acre and ADAM, and also get rid AFT and AGAF due to low segment. We also want to introduce new products in traditional and low-end segments as the high demand and the strong knowledge of the company to this type of customers. This would help the company increase the market share in these segments. Introducing new products on these segments is a part of strategy that company is allowed following. Developing an R&D competency, increasing promotion, sales budget, and automation rate are the main areas company will heavily investing. Regarding to marketing, the team decided to reduce the price of own products. How much depends on the market share that the company is holding. Besides, we will cut a half of the amount spent on promotion budget and sales budget of AFT and AGAF. The reason is that although we want to get rid of these product lines, we still have some inventory left, so we still use money on promotion and sell to sell own inventory units. Moreover, we will maintain same amount of expenditure for Apple and ADAM while using $2 million to introduce Aloha to customers and take advantage to existing high-end stores to sell it. The same formula is applied to predict sales. Regarding production, we will apply old inventory policy to own products and develop new one for Apple. In detail, the new formula that sales forecast plus 2 months for safety stock and multiply 1% of scrap and rework product is applied. In terms of human resource, the spending for recruiting and training will be cut off because there is less demand on skilled workers when AFT and AGAP product lines are off while Apple and Acre mainly demand on machinery. In terms of finance, company will borrow long-term debt at reasonable amount. Secondly, we will balance between debt and equity to keep leverage level. In terms of quality management, the company will start investing $500,000 per criteria from 2020 to reduce